Good afternoon. Thank you for joining the CRANS Executive Roundtable Exit Strategy Series. This session, we will discuss strategic versus financial valuation, how to maximize your M&A price. I'm Christina Bui, Chief Revenue Officer at CRANS, and I am pleased to co-host this webinar with xrocket.io. Also, I would like to thank our sponsors, Portola Valley Partners and Link SV. Just to tell you a little bit about CRANS, for over 25 years, CRANS has advised and supported entrepreneurs and founders through the complexities of building high growth businesses. With over 300 career consultants, we specialize in outsourced accounting and finance, CFO advisory, technical accounting, NetSuite consulting, venture fund administration, and stock administration. We are part of the Addison Group with over 4,000 professionals in 24 offices across the country, with 7 brands serving various business verticals: IT, finance and accounting, HR, administrative, healthcare, and engineering. Without further ado, I would like to introduce you to my good friend, Mark Addison, the moderator. Mark is the founder and chairman of xRocket. Take it away, Mark.
Thank you, Christina. Let me take over the screen here for a second. Well, for the next few slides. Here we go. So as Christina said, xRocket is co-hosting this series of webinars with CRANS. We are a business unit of a 22-year-old marketing company called Rocket Science. We focus exclusively on helping CEOs maximize the valuations of their companies prior to exit. We have been privileged to ride shotgun in 19 exit scenarios and 5 IPOs. And if you're at all good at pattern recognition, when you ride shotgun through that many transactions, you start to see some patterns, and that's what we're doing. We're taking the learnings from all of that experience, and we're bringing that to CEOs and working hands-on with those CEOs to get their companies ready for exit, to get themselves ready for exit, and to maximize the valuation of the companies at exit. We have an innovative pricing model where we have a shared risk that makes us extremely motivated to succeed. And so that is what we're about. Let me key up the panel now. I'm going to let the panelists actually introduce themselves in more detail, but I'm going to give you a little bit of context right now. We're going to start with Steve Dowdy. He is a former entrepreneur turned investor at Portola Valley Partners. Then I'm going to tee up Tony Richardson. He's also a former entrepreneur turned investment banker and broker at Meridian Capital up in Seattle. Then we'll introduce Andrea Tiller. She's a consulting CFO with the CRANS Emerging Growth Practice. And then we're going to end it with Jim Cook. He's also a serial entrepreneur. He was on the founding teams of Mozilla, Netflix, Intuit, and now he's doing it all over again at Orbital Insight. So to tee up the topic today, this is webinar 2 in a series of 6. And the topic today is the difference between financial valuation and strategic valuation. And so to define that quickly, strategic valuation is when 2 + 2 = 7, when somehow the whole is worth more than the sum of the parts. When you have a company A that's worth 50 million and they buy a smaller company B that might be losing money, and somehow the combined entity is worth $100 million. So how does that happen? Well, it's not voodoo, it's not smoke and mirrors. Strategic valuation is actually recorded on the books. The CFOs on the panel can explain how the math works. So a number of ways. So for example, a bigger company might acquire a company that for its customer base, and maybe the acquisition candidate, for whatever reason, has been able to acquire those customers affordably. And larger companies says, wow, we could actually buy those customers in bulk by buying the entire company rather than acquiring those customers at whatever their higher expense is ourselves. So that's one way. Another way is to acquire a company for scale economies. Trucking and shipping companies do this all the time. It is far easier if you've got 10 trucks versus 100 trucks. It's far easier to optimize the fleet of 100 trucks and to optimize their locations and to drive down the cost and to make sure that more of the truck runs are revenue generating truck runs. You might acquire a company simply to plug a technology hole in your product line. And actually this relates to the bullet a little bit further down about build versus buy. A lot of times that analysis is not so much can we build it, because any company with some resources can build it, but do they want to take the time? Would it be faster time to revenue if they bought a company? So rather than going out and having to recruit the staff and develop the technology and get ready for market and then deploy it and then start to recognize revenues from it, they could buy an existing company that's already assembled the team, already developed the technology. They can plug that company into the bigger acquiring company, and they can deploy and start making revenues off of that immediately. And the last bullet, I'll explain a little bit: valuation multiple expansion. This is the classic private equity model where the PE firm might acquire a roll-up. You've heard of roll-ups. The PE firm will typically buy a medium-sized company that serves as the platform, and then they'll start to acquire smaller adjacent companies called tuck-ins. And the reason why that makes the math work, the 2 + 2 = 7 work, is typically the way that valuation is recognized when you're looking at EBITDA and multiples of EBITDA. Smaller revenue companies tend to get a smaller multiple over EBITDA in terms of the valuation, and larger companies tend to get a higher multiple. So if the larger company acquires the smaller company, you more or less instantly have a higher multiple in that smaller company. So again, the whole is worth more than the sum of the parts when you do that. But all of the bullets on the screen are, in a way, almost the easy way to do it, the way to financially engineer it. And I'm going to show you 3 examples, and then the panelists are going to illustrate even more of deals that get into the billion-dollar bracket. And you'll see that there's more nuance, there's more strategy to it. So let's start with PayPal's acquisition of Honey Science. It was fairly recent. It was PayPal's largest acquisition to date. They have done plenty of acquisitions before. For instance, they acquired a fraud protection company called Simility. They paid $120 million for that. Then they went and acquired Venmo, which was actually part of Braintree. So they got a 2-for-1, and they paid $800 million for that. And they got a mobile payments. Then they acquired Zoom to get international payments. They paid $890 million for that. All great deals for the founders of those companies, but none of them in the billion-dollar leagues, right? None of them in the 10.9, 10 to the 9th league. Why is it that PayPal was now willing to spend $4 billion on Honey Science? So the way the equity analysts evaluated this deal and explained this deal is Honey Science, well, I should add that Honey Science actually didn't bring with it that many customers. So it wasn't one of those buy customers in bulk types of acquisitions. It was more strategic than even that. I think Honey Science had about 17 million customers and about 30,000 merchant customers. So compared to PayPal, relatively small. But what Honey Science did bring to the table, according to the equity analysts that I evaluated, was it moved PayPal forward out of just being a back-end payments gateway and towards becoming a total commerce platform. It brought them customer-facing relationships and merchant-facing relationships and sort of one-stop total commerce platform. And you'll see this as a common theme, that forward-looking story has a big impact on strategic valuation. So let's go to another deal. I chose this one because probably many of you saw that this week Amazon announced that they intend to acquire MGM for $8.4 billion. It reminded me of this deal from a few years ago when Disney acquired Marvel Studios, and I wanted to say, how did that work out for them? So Disney acquired Marvel Studios for $4.2 billion. Marvel Studios had been a successful comic book brand in the past. It was almost like acquiring a patent portfolio, but instead of technology patents, you had characters, you had intellectual property around characters. And what Disney saw, and the reason why this was strategic, they saw a company that had essentially tired assets that weren't being maximized. So those characters were being just licensed in comic books, but that wasn't maximum value. The company wasn't growing. Disney thought, hey, if we plug those characters into our movies, we might be able to make a bunch of money. And they bet right, and the deal has worked out quite well for them. And I expect that the Amazon deal is going to work out quite well for them. Disney is able to make about $2.2 billion annually from the movies that they have built around these Marvel characters. They've added over $20 billion to their market cap, and from a $4 billion acquisition. So it's done quite well for them. The last example I wanted to bring to the table is Google's acquisition of Looker. The reason why I bring this one up is because it's one of the few instances where we can actually pin an exact number to the strategic valuation premium. And that number is $1 billion. And how do we know that? We know that because Looker had just 6 months prior to the acquisition done a funding round, and they were valued at that funding round at $1.6 billion. And Google ultimately paid $2.6 billion to get Looker. So $1 billion strategic premium, that's the number. Why? The question is, why were they willing to pay that much? Well, the rationale, again, I went combing through the equity analyst reports, and the rationale that I understand is essentially Google Cloud was playing a distant third behind AWS and Microsoft Azure, and they needed to get a jump on the market. So they were looking for a technology that could get them there. Looker promised to bring them an end-to-end analytics platform that could collect data, analyze data, visualize data, not just across Google Cloud, but also across Azure and AWS, and also across on-premise databases and ISV applications. So potentially very game-changing technology that, again, potentially looking forward could vault Google Cloud further ahead vis-a-vis AWS and Microsoft Azure. So those are 3 examples of strategic valuation as in the deals. The panel now is going to illustrate those with more of their own examples. I already gave you a quick overview of their backgrounds, but I'm going to tee up Steve Dowdy first from Portola Valley Ventures, our partners, sorry. Steve, you and I have talked many times about how one of the underappreciated aspects to pitching to investors, pitching to potential buyers, is the narrative and the story, and how you are able to articulate the strategic value and the potential strategic value of the deal. So take it away, Steve.
Thank you. Back in the day, we were a systems integrator, so consulting company. We were using a product called Power Builder. We were using the old Compact System Pros. This is in the 90s, but we were really just coders, right? We were sitting down writing applications. And we had this kind of framework that we developed that made us look different than some of the other folks. Certainly the Anderson Consultings, the KPMGs of the day. And our focus was on client server migration. Well, the first thing is that we showed that we were in a real market. We grew from 12 million in revenues in our first year all the way to 81 in our 4th year. So, and a lot of this through acquisition, by the way. but we demonstrated that there was something there. There's a there. We spent a lot of time on thought leadership. We even wrote a book. We would go into companies and say, we wrote the book on downsizing. We wrote the book on client server migration, which included a lot of the IP. And let me talk about IP for a sec. When I talk about IP, it doesn't necessarily mean patented intellectual property. It really means what are the proprietary methods that your company uses that makes you stand apart from all the others that could be in your segment, your sector. And so we had this approach that we had developed called Blueprint, and that was different enough because it was a whole new world in client server that it made us stand out, from all the others. And there was a lot of concern about, oh my God, how are we going to make all these systems work together? And so we actually created a laboratory proving that we could actually connect all these different products and services together. So we got rid of the fear, uncertainty, and doubt. Anyway, after 4 years, we were acquired for $465 million, which at the time when most service companies were getting 1 to 2x revenue, we almost got 6x revenue. So interesting, things I'll expound upon a little bit in a minute. The other big one for me was Hotmail. And by the way, I doubt that any of you have seen that logo. This is the logo that we had when I joined, which is when we had 100 users. And whether you knew it or not, Hotmail actually is a play on HTML. So it's HTML mail, Hotmail. Okay. Anyway, we kind of cleaned that up a little bit. But once again, we came in and we said, look, there's a real market here. We are participating in a business that actually is a business. We happen to have created a new category, and the way we described ourselves was the world's largest free email service. We didn't want to say the world's first free email service because we really wanted there to be some legitimacy behind the fact that this is a new category and we weren't the only ones defining our own category. And we went out and made a lot of noise about this. In fact, this is back in the day when you wanted to be in print and there was a lot of print media out there. And within the first, I think, 9 months, we had almost 2,000 mentions in print, including articles about us. Now, here's another aspect of what it means to get acquired. And that is, who are the big players in this space that you're in? In our case, it was all the portals back in the day. And these were the usual suspects back in the 90s, in the late 90s. And of course, they all had the same basic stuff, right? They were essentially, with some differences, they all essentially offered the same thing. Our goal was to say, well, guess what? None of you are offering web-based email. So the idea here was to say, well, this is a hole in your offerings. This is something you need to have. And through a lot of the thought leadership that we were creating and the media blitz, and in fact, the proof of concept, which is that people actually think this is important, we created the notion that they all had to have this. Of course, another company came along and they thought it was a good idea too, but they were about 6 months behind us. Our trajectory is such that they couldn't catch us. They ended up being acquired by Yahoo. That became Yahoo Mail. And of course, we ended up being acquired by MSN. Even though we only had 4 million in revenue, that we were bought for 100 times that in Microsoft stock. So a couple of interesting points here, and let me just sort of summarize some of the lessons from at least those two and all the others that I've been a part of in my career. When you start a company, you're marketing your people. The topic here is sell your smarts. You want to be the smartest kid on the block. You're marketing your people to investors. Then you're marketing your products to your customers. And then what a lot of companies that I've worked with miss is that you're next marketing your company to the people that you think will acquire you. And all of those three are done at once when you get to that point, when you get to the point where you have customers And now you're talking about, well, we really need to start to say, why are we an important part of this industry or this industry segment? On the other side, my experience is of course, our products are designed initially to try to attract investors. But then when we have customers, we'll talk to our customers and we'll adapt our product for the customers. And then as we understand the opportunity in the acquisition space, we might even produce features that we believe are going to make us more attractive. So we want to create, through our marketing and through the product offerings we have, thought leadership that creates envy in the marketplace. Next thing is, we want to make sure that everyone understands that this is real. We are real. Now, you can define that any way you want to. What you want to create, though, is that people are saying, uh-oh, this is something that we didn't think of, or we missed this, or this actually could be something big. And then, as you know, what you want to sort of project out into the world is there's something happening here that actually could be threatening to a lot of existing businesses. And so we want to make sure that we are out there saying, not only are we leading the thought in this area, but we're going to be growing and invading your businesses potentially. Then we think about finding or creating holes. A lot of businesses, existing businesses, have several players, the 500-pound gorillas that are out there. And of course, they all have their offerings. But what if we either identified gaps that a lot of them shared, or we have a new opportunity that they all need to have if they're thinking about the future of their business, and we're the only ones that are providing that. And so the only way you really know to do that is if you have what I call extreme competitive intelligence. The startups that I work with, not very many of them have gone to the extent that you need to really understand the ins and outs, the great details of your competitors, and knowing them so well as you know your own company, that you are conversant with any of the other players out there, and you can talk about them and how you relate to them and how you relate to the market that they're in. So I urge everybody to over-invest in competitive knowledge. And then finally, how do we start the auction? How do we, create this bidding war where companies think about, well, wow, what if we could, what could we do with this company? And in fact, if you're not in a competitive situation, you're going to get the financial value of your company in an acquisition. If you're in a competitive situation, you're going to get the market value of your company. And that's really important. And clearly what Mark has already showed us is that the market value of your company could be several multiples of the financial value of your company. And of course, we want to create fear. We want people to worry that, someone else is going to grab our company before we do. And that creates a lot of motivation. I call it, musical chairs, because even if there's another provider similar to us, we want to be let's say out of, or we want fewer sellers than there are buyers in a given space. And we can engineer that. You can engineer that with your company if you think through the competitive landscape, where you fit in that, and where that whole sector is going. And I'll just wrap up by saying, what's really interesting and what I've learned is that a lot of this is about emotion. It's not necessarily about numbers. And it's how do you project the kind of emotion you want people to feel and think about your company as you are in the marketplace and as you become an interesting target for people to acquire. And I'll stop there.
Perfect. Thanks, Steve. So yeah, we saw in the PayPal acquisitions that simply filling a technical hole can get you a good exit, but not necessarily a multi-billion-dollar exit. But what I'm just going to underscore a few points that I jotted down when you were talking. You ended up with emotion at the beginning. You talked about fear of missing out. And especially if you can claim that you are the only competitor in a space, that fear of missing out, that fear that, well, if we don't buy them, that our competitor will, can drive valuation, can drive bidding wars, can drive that perceived strategic valuation. I'm going to hand it off now to Tony Richardson. Tony, you are an investment banker and broker, and you've seen a lot of deals. Tell us, when do you see a deal where you're going, okay, it's a nice deal, it's accretive value, and when do you see a deal where you're going, okay, that has strategic valuation, that is an important deal?
Yeah, thank you, Mark. So a little background real quick. Meridian Capital, we're a lower middle market investment bank, do transactions primarily on the sell side, 20 million up to 500 million enterprise value. My background prior to that, I was a technologist at Microsoft, left, started my own company, grew that through acquisitions, eventually exited that business, and I've been doing primarily sell-side M&A in the technology business services space for about the last 5 years since then. So, interesting from valuation perspectives, what's going on in the industry. Not everybody can have that, very unique business that can drive these multi-billion-dollar multiples, but there's a lot of things that you can do in your industries that will differentiate you and give you that extra valuation. There's a couple factors that are out of our control that are playing very well right now: the economy, tax structure, interest rates. From an economy perspective, I mean, when the public markets and public company valuations, when public markets are doing great, public company valuations follow those, and then in line, the high tide floats all boats analogy that impacts private company valuations as well. In fact, while 2020 from an overall metric of number of deals and transactions that happened was significantly down due to COVID, the previous high of valuations over the last 15 years was 2016, and the median valuation for deals done in 2020 actually exceeded that and is continuing to be high in Q1. Other things that are driving that are kind of the access to credit and interest rates. So if interest rates are low, you've got more potential buyers that are able to pay higher valuations. So you've got private equity that are able to put more leverage on deals, and so they're paying higher valuations, especially when they see good assets, when they see interesting companies out there that they believe they can help grow. Then they're willing to pay that added that extra multiple, that extra turn on valuation. And then taxes. There's a lot of uncertainty around changes in the tax code, and so that often causes kind of a short-term uptick in activity, which helps drive valuation. So how can you position your business in the short term? So understanding, and a lot of these things are some of the things that Steve talked about: differentiation in your industry, in your market. How can you differentiate? First of all, obviously, you're attractive if you have good growth. Your EBITDA and profitability margins are good. You've got a diverse customer base and size, and you're regionally focused. The more diverse and the higher the growth that you can achieve, it will certainly help your attractiveness and the value that you will drive in the market. But some of the other items that really kind of help differentiate businesses are, a unique service offering. So are you serving a unique end market? Are you in a position where you have a solution or product that solves maybe an old product, but in a newer, unique way that is more efficient than your competitors? Or are you in a scenario where you're able to consistently beat kind of that 500-pound gorilla at their game? So you're beating them head to head. And those businesses, a lot of times they get upset or simply don't like getting consistently beat out by these smaller, more agile businesses, and they will look at you as a potential acquisition. So part of what we talk to with businesses, 3 to 4 years before they even want to go to market is, one, talking about the key KPIs in their industry that will help drive value, what the industry is looking for, who the buyers are, and then encourage them to figure out who are the top 10 to 20 businesses that, whether those are strategics or private equity that are doing roll-ups in their market that might be potential buyers in the future, and kind of understand how they can beat those businesses, where they're more efficient, and what types of things those businesses are looking at, and getting to know them, getting to know the CEOs and executives at those companies, because those are oftentimes future acquirers. And if they get to know you and understand how efficient you run your business, the fact that you guys are able to pivot, you have great, strong technology team, innovative products, a great roadmap going forward, it just makes that strategy of getting that ideal price much higher when the timing is right for you to go out and maybe market your business. And maybe you don't have to do a broad market because a handful of your competitors or companies that have complementary services in your industry know who you are and what you're doing. Some other differentiators are simply having some of the best tech resources in a niche market. It's super competitive recruiting developers and other technology folks, but there are certainly niche and unique ways to differentiate. And with everything going remote, it's making it a little bit easier for some of these smaller companies to compete with, the Amazons, the Googles, the Facebooks, these companies that are scooping up a lot of the tech talent in the local markets. So I think just a kind of a quick recap, understanding, where the market trends in your industry are going, who the potential acquirers are, and knowing what their strategies are and where they're going in the future. If you want to sell your business in 5 years, you should have a list of 10 to 12 potential companies that you think would be potential buyers, and why they would specifically be interested in you and what you solve for them that they can't solve themselves. A lot of these companies, especially if you're a technology play, they look at, okay, how long will it take me to develop or build out a practice area that these guys have? Is it 2 years? Is it 3 years? How much does it cost? And if I take 2 to 3 years to build this, am I behind because they've kept, they've raised the bar even further? And so they will do that sort of analysis. If your product or offering isn't too complicated or too niche, the barrier to entry is too easy for other people to come in, then it's probably not something that a business is going to pay a premium for. So a lot of those things, just kind of building out your roadmap of acquisition, running your business effectively, even with a goal of acquisition later on, your business will be primed to run efficiently, even if you never do an acquisition or just continue running the business. So having that in the back of your mind as you move through the roadmap of what your business strategy is, I think is always a good thing. And I'll kind of wrap with that, Mark, and hand it back over.
Yeah, Tony, thanks. I was going to underscore something you spoke about at the very beginning about the private equity buyers. So they have really evolved, right? They used to be the classic private equity deal. They were bottom fishers. They were value buyers. They were looking to consolidate back office operations, combine two business, fire the marketing, fire the HR team, save some money, repackage it up and sell to somebody else. Because they have so much money burning a hole in their pockets these days, they have become strategic buyers in many instances. They are now willing to buy companies at strategic valuations. They are willing to invest in those companies. They've become almost like market makers in that they have the wherewithal to gather up several companies, several interesting companies in a space, and either reconfigure them or combine them or invest in them in some cases, and then put them back on the market. So very different player than they used to be even a few years ago.
Yeah, you're exactly right, Mark. 7, 8, 10 years ago, private equity was rarely the highest bidders. They had strategies just to do roll-ups, and now they're looking at technology and niche markets and basically looking to hold and add on to these strategic platforms, and they're paying competitive rates. And 5 years ago, if you had 3 strategics and 10 private equity, two of the 3 strategics were usually the highest bidders. But private equity has all this money that they have to put to work, and they know what they have to pay to get them. And so when they see an asset that they think they can really run with, they're paying very competitive valuations now. It's not the case that strategics are always the highest bidders. So it's definitely been a shift.
Yeah, yeah. Okay, Andrea, you're from the CFO perspective where you sit, you see a lot of companies. You also do a lot of CEO coaching. So tell us from your perspective how you see this game playing out.
Yeah, thanks, Mark. It's a pleasure to be here today. You've heard a little bit about Krantz from Christina. We're the preeminent accounting and financial solution firm helping startups and venture capital firms grow. We've supported over 2,000 venture-backed startups and provided direct fund administration for over 1,000 funds. So this is the heart and soul of what happens in Silicon Valley. Personally, I've been a CFO for a little over 25 years. I've spent half that time in perm roles and half in consulting, going back and forth. So I've been a perm CFO for both publicly traded companies as well as venture capital backed firms. It's kind of been really fun, working with Krantz and their specific markets. I've probably seen over 100 transactions just in the last 4 years. Because we do a lot of transaction services, a lot of M&A work, a bit of IPO, a bit of SPAC, I think, just like everybody else. But the perspective is going to be here a little bit from the left side of the ledger, so let's talk CFO. At its simplest, companies realize financial value based upon their current and reasonably assurable future performance as a standalone company. What most people don't realize is that just about every aspect of your company's performance can be measured by its financial impact. And that impact will then translate into financial valuation based on current market and industry comparables, as well as a variety of different standard valuation methodologies, such as present value of future cash flows. So I know for me, when I'm looking at, coaching or counseling a startup, predominantly because we're so heavy in the technology space, it's usually around new product development. We look at several different metrics. We look at, a family of products where you look at what can you get to the market quickly in 3 to 4 months. You might even think of those as features. What's a typical 9 to 12 month new product development cycle? And then how much are you going to invest in platforms which have 5 to 7 year lives in technology? And then within that, for every project, we'll look at what its costs are, what its expected returns are. We'll create an ROI hierarchy. We do the similar things for sales and marketing and operations and what have you. The place where it gets interesting, and you've heard this, I think, from all of the speakers today, is where your company can find strategic valuation. And that's usually for a particular acquirer who may realize additional financial benefits beyond your standalone projections. So in addition to some of the examples people have provided so far today, let's talk about a couple of generic ones. Company A sells widgets. If you can offer a bundle with your product B and that drives 10 times the sales of widgets, they will realize greater financial reward than just your current standalone sales of product B, and they will pay more for that as well. One of the ones that I think is really interesting, particularly because we've recently done some work in this space on an IPO and a SPAC. Company C has a well-established R&D capability for pharmaceuticals therapy development, but they want to expand into mRNA-driven monoclonal antibody development. All their internal estimates are that it would take 6 years and $200 million to develop this capability internally. Your company just received FDA approval for its first monoclonal antibody therapy. Your strategic value to company C is your standalone financial value plus the value to them of having an instant mRNA capability. So one of the speakers earlier was talking about, speed to market. If it's going to take you 3 years to make it, but 4 months to buy it, often buying it, results in a really high premium. We've had another client as well. I just call them Company D, and they market liquor. They're well known for their middle market brands, and they've been trying to penetrate the adjacent premium brand space, but their brands are so strongly established as middle market that they can't establish any brand capability or credibility with the luxury consumer. Your company produces and markets a jalapeno-infused tequila, which is the darling of the celebrity crowd. You get my drift. So all of these result in strategic value to the acquiring company above and beyond the standalone value of your company. One of the things that I think is most interesting, and Mark hinted at this, is there's a real linchpin here in terms of executing a strategic valuation strategy. And that linchpin is the role of the CEO. Most CFOs are very close partners with their CEO. We sit at their left hand. We help them implement their vision. But we observe them as well, and we observe what makes them successful and how they drive success for their companies. One of the pitfalls is, as you become a CEO, you're not really supposed to be doing the CMO guy's job. He can take care of marketing. And you're not really supposed to be doing the CTO guy's job. He can take care of technology and product development. Your COO can forecast capabilities and capacities and, optimize for your production. And of course, your CFO can manage your capital needs and availability. But one of the most critical jobs for the CEO is the ability to weld these components into a strategic vision for his or her company. And that is actually only the first step. Okay, once you have that strategic vision, you have a plan to execute it, there is, what I'll kind of call a soft-sided role that's very important. And what that is to establish your company and your company's relationships in the right industries. The places, the ponds that you're playing in. You want people to know who your company is, to understand what it is they do, have a clear vision of the benefits and the opportunities available to a company of your caliber. You need to establish that, that brand equity or that credibility, within your industry. Even more importantly, you need to establish a similar type of understanding and perception of your company with thought leaders. So you need to understand, who it is who's driving market strategic vision, whether it's media, whether it's technology developers, whether it's marketers, whether it's key companies. You want to be seen by those thought leaders as attractive. And in fact, you want to be perceived as being one of those thought leaders. And so there's work to be done to establish that credibility. In addition to that, you want to make sure you know the best iBankers and that they know you. And the PE firms who operate, in your industry or your peripheral industries, and they know you. And you want to be sure that you have relationships with the CEOs of all of those various kinds of companies, whether they're competitors or players or thought leaders or deal makers or bankers or capital providers, because all of these have the potential to be a strategic buyer. Strategic deals don't often happen on the turn of a dime. They often happen because the timing's right and the players are known. So participate actively in your community of stakeholders. That would be my CEO coaching for the day. Thanks, Mark.
Yeah, Andrea, I'm glad you brought that up. creating that platform for a CEO to be a thought leader, sort of core and central to what we do. And it is the soft side of the business, but it's so vitally important. I'm going to turn over now to Jim Cook. When you start to hear him talk, you'll realize that he's basically storing up potential energy right now, and he needs to let it become kinetic energy. He's a whirlwind. He's an entrepreneur. He's a CFO, but he doesn't sound like one. I'll let you do the honors and tell you all the successes that you've had at Intuit and Netflix and Mozilla. Jim Cook, take it away. But unmute yourself first.
Let's try unmuting myself. I've only been doing these Zooms for I don't know how long, a year now. Hey, everybody. Jim Cook. Yeah, I'm currently an active CFO at Orbital Insight. We are a Series E-backed Sequoia Capital and GV private venture-backed company. We do geospatial analytics. I tend to try to do hard things. Geospatial analytics is a mouthful. We take imagery from space and we throw computer vision at it and try to make insights on what's happening on into the Earth. But yeah, my background has been in other hard things. Intuit wasn't that hard, but nobody knew about it in the early 90s. Netflix, everybody thought we were crazy. I helped start the company 4 years ago. So it's a different Netflix than you know today. Red envelopes. I helped build those and ship them. Streaming wasn't even on the horizon. Everybody thought we were crazy. Mozilla was another crazy attempt at recreating the browser market, and it worked with about 18 employees in 2005. So I've had a lot of fun. I think I've been more lucky than good, but you've heard a lot of great insights today, and so I'm not going to, what you heard from Andrea, Steve, and Tony and Mark are really great insights. So I'm just going to try to play on them a little bit and maybe stitch them all together and open up for questions really fast. For me, when I was asked to join this, I was happy because a strategic valuation means to me not a financial valuation. So I think in opposites. And you've heard that from these panelists today. How do you create a strategic valuation? Let me just go to some examples, right? For me, in my experience and firsthand experience and stories, it's around creating a rabid customer focus. The companies that win have just this amazing customer focus and customer brand. So think about how to do that. These companies are relentlessly close to the customer. And I'm bringing this up because a lot of Silicon Valley companies say they are, but they really aren't really close to the customer. When I talk about being close to the customer, I'm talking about your VP of engineering and your VP of sales and your VP of product actually talking to actual customers and being on customer calls, and then having a one voice inside the company. This is how companies win. I've been at a lot of companies where communities matter a lot. And if you really think about, and what Mark Addison talked about, pattern matching, think about all the communities and the huge strategic valuations from companies that have built products with communities. Not the communities that, from my experience, but let's just think about TiVo, the community of a TiVo user, or the community of, well, I will bring in the DVD communities, or the Mozilla Firefox volunteer community of browsers, just these rabid volunteers that turn into something much bigger. So I guess the bottom line is there's loyalty value and brand value, which creates a huge strategic valuation. So play that up as much as you can. The examples I have for you are, let's remember the smartphone industry in the mid 2000s. We were coming off of BlackBerry. BlackBerry was awesome. You can type on your keyboard, and that came off of flip phones. And along comes iPhone and says, forget about all that. We're going to create this new smartphone category. And they were right, but it would have failed. And I remind people all the time that the iPhone would have failed if not for one thing. And that one thing was the App Store. Without the actual App Store and a community of developers who were creating products for the piece of hardware, the iPhone would have failed. I guarantee it. How do I know? Because the Microsoft smartphone you don't see anymore. Microsoft had way more money. They came at it and tried to build their smartphone that we all may remember, but what did they not have? They did not have an app store. Google came along and said, we can do it with Android. We're going to cobble together some open source code, but that wouldn't have survived without the Google Play App Store. And so these are examples of ecosystems and communities. Bottom line, brand value is a huge intangible here. Build it, pay attention to your customers. I'll just wrap up with this. Make sure you create buzz. I think many of our panelists talked about creating this buzz in the industry. You can become a story stock, but you only can become a story stock by your customers talking about you all the time. And if you believe that, then you have to focus on your customers. Second key tip, act your stage. I think both Steve, I think all three panelists, even four even, talked about psychology. This is all about psychology, right? It's all about the buyer's psychology. Psychology is about fear and greed. If you're in a fear part of the cycle, you're not going to get a big valuation. If you're in a greed part of the cycle, you're going to get an outsized valuation. Another tip, does your buyer view you as a defensive acquisition or an offensive acquisition? It's a different way of saying, I think, what Steve and Tony were talking about. Defensively, oh my gosh, I have to buy this company because if I don't buy it, my competitor is going to buy it. That's a really good positioning for your company. Offensive acquisition, I think you heard Steve and Tony talk a little bit about that. It's really going to be the 2 + 2 = 7. I guess at the end of the day, optimize for the handshake of the deal. A lot of these deals, and Andrea talked about this, happen over long-term relationships. This is not about convincing. Be very careful. Do not fall prey to convincing the corp dev department back office to do, the due diligence, the metrics matter. That's not how strategic valuations are done. They're never done that way. They're done with the CEO shaking hands with the other CEO and saying, I'm going to convince our board to do this. If you want a strategic valuation, optimize for the handshake. And, I'll just leave you with this, right? And I think this was Tony was talking about this. Be proactive when the market landscape changes. What am I talking about? Let's just look at what happened in the last year. Zoom, the thing we're on right now, was a distant second to a company called Polycom. They were struggling as a hardware manufacturer of disrupting conference rooms and offices. COVID comes along and the whole landscape changes for video conferencing. I guess someone should have acquired Zoom, noticing that happen. If that's happening in your industry and you were thinking about selling, jump on that. Pay attention to the industry. Let's look at Peloton, TempoFit, Tonal, all these home gyms. Once upon a time, we would kind of laugh at Chuck Norris or Beachbody on the infomercials. If you think about what this market is, it's an infomercial market. Oh, but now with COVID, we can bring the home gym to you and actually bring it into the cloud. Oh, we just thought about this a different way, and now it's a multi-billion-dollar opportunity. If you're in one of these markets and the inflection point of the industry has changed, play it up. That's how you get a strategic valuation and really outsized gains. So that's it, Mark. Turn it back over to you. And hopefully we have a little time for questions.
We do. Christina, maybe you want to review some of those, and I'll just wrap up a few notes. So I guess what I took away listening to all of you, first of all, you can create strategic valuation. Okay, so it's not like it has to be given to you, but you have to know where to go look for it. You need to know how to message it. You need to how to tell that story. Another pattern that I saw in a lot of your examples was this notion of not, I think, Andrea, you call it sort of like standalone versus, but I'm calling it like the future potential. And we all know this, right? Because when we raised our first round, right? And we had an MVP, we were selling a dream, right? And we got a valuation based not on how many of those widgets we had sold and how many features we had finished, but look, it's working now and look what it could be, right? And sometimes the second round is harder because then you do have 2 years of operations under your belt. You are expected to have delivered a certain number of customers and a certain amount of revenues at a certain amount of profit. You can't sell in the dream quite as hard as you did when you were earlier, right? But then you go towards the end, towards the acquisition, and in a way, you can sell the vision again, right? You can say, look, we've built this fabulous company and it makes a certain amount of money at a certain amount of profit. That is worth X. Now, let me tell you why it's worth X plus Y. And that's your vision again. That's your future potential. That's all the things that it could be worth if in the right hands. And I guess that was my big takeaway, is like, think to the future, think about how you tell that story, think about how you become a sector leader, build a platform for yourself so that when you go in to your potential acquirer and tell that story, you've got some credibility with you, you've got a community behind you, or if you've got a whole platform and leadership behind you. So there are ways you can create strategic valuation. So Christina, what questions do you have?
Just one question, and that's all we have time for. Do companies with strategic investors on their cap table have advantage in terms of potential acquisition as compared to companies that do not have one? Anybody want to take that?
I'll start. My first reaction is I actually go opposite the strategic value. I think that might actually not be great, because a strategic investor on your cap table has seen probably more information than a non-investor, and yes, they might want to buy you, but you better market it outside of your strategic cap table. If you're going to go through a process and a bid's coming in, don't take the first bid, basically.
Yeah.
Go outside your cap table to make sure it's a fair value if you do get an offer like that.
Thank you.
I saw another question come in, Christina, about higher valuations, and is it harder to sell at higher valuations because there's fewer buyers who can buy you? So the answer is absolutely yes. But that's good and bad, right? If you're swinging for the fences for $1 billion valuation, yes, there are very few companies on the planet that can afford that kind of acquisition. So you better have the company to go for it. But that's not the only way you can sell your company, and it's topic for a whole other webinar. But there's plenty of ways that you can do smaller exits at smaller valuations using, there's even marketplaces now. Like there's one called MicroAcquire, just for small companies to do small exits, and SaaS businesses are perfect. All kinds of PE companies are looking to snap up SaaS businesses these days and take over for founders. So I wanted to address that question. Christina?
Yeah, and then one thing to add to that, because we see it, in a small percentage of our client base. It's all well and good to hold out for that $1 billion valuation, as long as you've got what it takes to earn it. We have a lot of very early stage companies who think their companies are worth $1 billion, and they may miss some really good deals along the way to build incremental value, holding out for something that they may not quite be ready for yet.
Hey, Mark, I would add real quick as well. One of the benefits of really understanding the competition, which ultimately could be your buyer, is your value is not going to be your standalone financial value. It's going to be what is the incremental or the accretive value that they get from having you. And if you know enough about them, you'll be able to model their business with you in it and understand what that uptick is, what that additional value is. It's absolutely going to be more than what you're worth on your own. So that's another plug for really know a lot about the businesses that are out there.
Yeah, know how to calculate 2 + 2 = 7.
Exactly.
Yeah. Excellent point.
And I'll just wrap it up with be very careful with only one buyer. You have to create scarcity. You have to create demand by having multiple bidders if you really want to create strategic value.
Yeah.
Okay, great. Well, thank you so much, Jim, Steve, Andrea, Tony, and Mark. That was amazing. Like one of the attendees wrote in the chat, and thank you for joining us. Thank you for your time, and we look forward to seeing you on June 24th at our next event, and make sure you sign up. So thank you all for joining, and have a great afternoon.